Glenn, we spoke to you just a couple of weeks ago. You were very bearish at that stage, although you were turning a little bit more positive. I was a bit concerned that Paul Hansen was rubbing off on you in our Bulls and Bears debate. How are you feeling at the moment?
Well, I've got rid of Paul, so it's a good sign. So clearly I'm in the ascendancy here. I'm feeling okay. I think where I was somewhat less bearish than I think I need to kind of point out is that we're just seeing a lot of managers around the world, a lot of companies, and they were saying at the stock level they're finding a lot of exciting opportunities, and I have to agree with them. We have to talk separately when we talk about the equity, the overall index level. So I remain pretty bearish. I mean, I think we're in a very, very difficult situation. I love it when the IMF comes and saves the world with 600 billion euros. We think we need 10 times that sum of money to make any dent whatsoever. But the markets want good news. They are oversold. They've had a bit of a fall, and they're looking for an excuse to rally a bit.
Can we break it up into the short term, medium term, and the long term? I think that's possibly an appropriate way to look at the market right now. So short term, you're saying we're in need of a rally? Yeah,
I think short term we're going to have volatility, and we've said this, and I think what we're going to get is kind of plus 15, minus 20 all the time. So it's going to be ending downwards. If we look 3 and 5 years out, we're going to be lower, I suspect, maybe not 5 years, 1 to 3 years. Depends on the actions that authorities do take to sort it out. But a lot of volatility. Just when you get very, very bearish, it's going to kind of rally. So if we expect that, I think we have an advantage.
So you're saying a structural bear market over the next 7 to 8 years?
I think we've had, I would say we've had since 2000, we already had one. So we're 11 years into this, and I think we've got another 4 years. So 15 years would kind of be my target. But I think it could be longer if they make these mistakes. And actually one of the mistakes they make is what everyone gets very excited about. Let's print more money, have more quantitative easing, have more bailouts. That means more debt. And that means even if we have a rally for 6 or 12 months, it has to be paid back. And then some sanity prevails and we start going down again.
But I mean, Europe is a classic situation of never being able to get out of that particular cycle, because the future generation is getting smaller and smaller, and they won't be able to take on the debt burden.
I think that's too
far.
It's
an aging population, the
exactly
biggest
right.
risk to the retirement industry.
Which is effectively what's happened in Japan as well. I think, my view is the Japanese situation will prevail in Europe. So we'll get 20 years of really no growth.
I
need Hansen against me here, because I agree with you 100%. We need to add something else. It's not just the demographics within. We also have the size of government as a proportion of the economy. And when that becomes too big, there's nothing left to tax. There's very little productive capacity left. And I think in Europe we're starting to hit some of those constraints.
Okay, but now I'm going to flip on you and say to you, in Asia, what the one trend that's happened over the last 3 years is that consumers are starting to spend their savings rather than sitting on top of their savings. So if you're looking at Singapore, Thailand, Indonesia, savings rates used to be as high as 30%. In Singapore it was 55% 6-7 years ago. It's certainly come down from those levels. So, don't you think that Asia to some extent is going to help the global economy go forward?
Oh, there's no debate whatsoever. I mean, the baton of growth and where you need to look for leadership in terms of global economies has moved from west to east. There's actually no debate about that whatsoever. But there are some problems there too. In China, we would argue there's a kind of few bubbles out there as well, and they too, even if they grow strongly over time, will have their up and down cycles. America had a wonderful century, but they had 2 depressions within that and a number of recessions. So even though Asia absolutely from a strategic perspective is going to be the area of growth, we're going to have some ups and downs there
Let's
too.
talk about this changing investment landscape and perhaps drill down into some of the stats. 2001, China was around about 1.8% of the global economy. Sitting today, we're at around about just over 10% of the global economy. And now, the converse, if you look at the US, sitting at 32% of the global economy in 2001, down to 23% today. So to put it in perspective, as Kevin Ling says, the US has lost an entire China. And if China maintains its growth rate, it's on track to become the biggest economy by 2020. That could be the saving grace for the 15-year horizon on the equity front.
It could. I mean, I think we need to look at equity slightly different to economics. And I think we've made that statement beforehand. We need to understand, I think, a very bearish economic backdrop. But equities, my key question, what's priced in? I think it's the only thing you really have to understand when it comes to asset class. We don't buy and sell economics. We don't buy and sell GDP growth. We buy and sell.
So you say all equity is already priced in anyway?
No, my question is it? And that was my difficulty when I last came on the show, to try and understand. We started in the 2000s, early 2000s, equities broadly, globally, were trading on about a 20 times multiple expensive. We've had a 10-year bear market. Those equities are now down to 10 times price earnings multiple, and they look cheap. The problem is we have an unprecedented period. We've never seen this ever before. Whenever can you name a period when the entire European continent and the Euro region could possibly go insolvent? And so what we're really struggling with is to say, has it priced that in? And I'll argue that's not priced in.
You mean the downside, the negativity that could result from the
In other words, I think in a normal type of world, at 20p you sell, 10 PE for markets broadly you buy. We're at 10 PE, and that's where I was struggling to say they're not looking bad value, and I still stick with that. However, we have an unprecedented world. And because you have an unprecedented world, where can you imagine that, I mean, obviously, and we know about Greece, and you know about Portugal, Italy, Spain, but add to that maybe the likes of France, and add to that Italy, etc. We've never experienced that. So we're used to countries going in, but entire continents is something
And the emerging market space, what are they pricing in? Have they already got all that good news at their fingertips?
No, they don't have all that good news at their fingertips. In fact, they've taken on a lot of the bad news. And in Asia, there's almost an attitude that, you know, if something goes wrong in the West, then it's got to be discounted in the price. And the other country we're forgetting is the Indian subcontinent.
Sure.
And the growth in that particular region. Yes, they are going through hard times right now, but you've got strong population growth and a growing middle class. So when one adds up the growth from that region, and you're looking at specific equities, focused equities such as PepsiCo, etc., they're certainly doing well in that entire region. And when you look at their earnings growth, well ahead of S&P 500 stocks right now.
I'm not 100% sure. I mean, I'm very, very confident that everyone is right in saying that America will be a smaller part of the pie going forward, and India, China, and all these others will be larger. What is priced in or not priced in is not clear to me. Again, speaking to 26 global managers, all of them, almost across the board, said they prefer the developed market countries. They found them cheaper equities, developed market equities, and they were selling often into India and other places, but still said, buy those ones, not the locals.
No, absolutely. You don't buy the locals, because, and especially in India, which is a more controlled market, you've got 20 PEs and 25. But, you know, going back to the likes of a Microsoft, a PepsiCo, they are cheaper ways of playing those
global brands
markets.
with exposure to emerging markets.
We're in agreement there.
Yeah.
Yeah.
What should investors do, in your opinion, in this environment? I'm sure diversification is at the key of any strategy that you're going to throw forward to.
Absolutely. It's a difficult world. I look at every single asset class and I find the pros and cons in every one. I mean, if we do have a difficult environment, equities always seem to react negatively to that, so they could be down, and yet they're the one asset class with decent yield and growth perspective. So you've got the, you know, on the one hand, Darren, and on the other side, Darren, you look at gold. I think it's a wonderful asset class to protect against inflation, but it has no yield, and it's actually fallen quite sharply recently. Look at property. I think there are bubbles in certain parts of the world, some of the major kind of city centres, residential property, Sydney, London still, Jerusalem. I mean, there's a whole lot of different areas where there's clear bubble, like Shanghai and some other areas as well. But across the board, I think property has merit, etc. And I think cash, which is a horrible asset class, because especially globally earning zero on it, actually protects you against the downside of market. So I think a case can be made for every asset class, and hence the diversification. If you can give money to a good manager, you can pick and do, you know, move between those, especially when you're getting plus or minus 20s. So equities down 20, you want that manager, if they're good, to buy in.
Okay. But what is your view on inflation over the next 5 years? Because that's going to be key to your asset allocation.
Yeah,
are we talking South African inflation or global inflation?
Global inflation.
Yeah, because I think South Africa would probably be easier. I think it's probably more on the inflationary side, and I think one should worry about it. I'm absolutely convinced the international answer is yes. We have both inflation and deflation. It's happening simultaneously. I believe we have inflation at the consumer level, and it's very significant. In the UK, you have inflation at 5.5%. If you look at what Volker is saying, inflation is in America, 7, 8, 9, 10%. We speak to some of the corporates who are saying what they're doing to, instead of passing on price increases, they cut the size of the chocolate, so you take out a few. That's inflation at the end of the day. But at the asset class level, we have deflation. At the macro perspective, that which I think bonds are pricing off is a deflation environment where you have massive deleveraging taking place. It's already taken place, I would argue, at the corporate level. I mean, they're sitting net cash. So they've deleveraged for a period of time. And at the consumer level in the West, look at America, I think a lot of that's happened. But the other parts, that still has to happen.